They called it intuition. The traders of Wall Street in the 20th century, cigars in hand, phones pressed to their ears, eyes glued to ticker tapes, relied on what they felt in their bones. They moved millions based on a hunch, a whisper, or the look in another trader's eyes. Back then, trading wasn't just a job. It was a high-stakes poker game, a battlefield of instincts and nerves. But today, the game has changed. Now, it's no longer just about who can shout the loudest or who's got the fastest reflexes. The modern world of trading is quiet, it's fast, it's mathematical. Algorithms, lines of code, and equations now make decisions in microseconds, executing trades faster than a human can blink. This is the story of how we got here. This is the story of how trading evolved from gut feeling to algorithms. The origins of trading go back thousands of years, far before the concept of a stock market even existed. In ancient Mesopotamia, traders bartered grain, livestock, and textiles, keeping records on clay tablets. Trade was localized, heavily reliant on face-to-face negotiations, and entirely driven by human interaction and trust. There were no charts, no indicators, just people, goods, and the value they assigned to them. Centuries later, as commerce expanded across empires, rudimentary financial systems began to take shape. In Venice during the Renaissance, merchants created informal markets for buying and selling debt. They didn't have stock exchanges, but they had a basic understanding of credit and speculation. Early versions of options and futures were being discussed in hushed tones on the streets and in taverns. Fast forward to the 17th century, and we arrive in Amsterdam, the birthplace of the modern stock exchange. The Dutch East India Company became the first company to issue shares to the public, allowing investors to speculate on its success. Suddenly, there was a centralized place for buying and selling ownership in businesses. Traders began to meet regularly, analyze company voyages, assess risk, and place their bets. The art of trading had begun to take a recognizable form, but even then, it was all human. Traders analyzed political events, weather patterns, and even rumors to make decisions. Charts didn't exist, algorithms were centuries away. The most valuable assets a trader possessed were their network, their memory, and their instinct. By the 19th century, trading had become faster and more structured. Telegraphs revolutionized communication. The ticker tape, a thin strip of paper with stock prices printed in real time, became the heartbeat of the market. Traders no longer had to be at the exchange to know what was going on. Suddenly, decisions could be made remotely, and speculation intensified. But what really changed the game was the 20th century. With the rise of computers in the 1960s and 70s, the foundations of modern-day algorithmic trading were laid. Early traders began using simple programs to track price movements,